so I would simply say to people right now that I don't expect interest rates to go lower. The conventional wisdom is that, that they're going to do it in June or July, and I think that's foolhardy at best. And that's what would spur even further growth in an already over-leveraged stock market. So for me, profit is not a four-letter word, and with it, bringing the market along for the ride. And so that's very dangerous as far as I'm concerned. It's very, very dangerous.
In today's market, frenzy. Andy Schectman sounds a note of caution in his recent video. He points out that while some stocks soar, many others struggle. Painting a worrisome picture with interest rates low and debt skyrocketing, Schectman questions the wisdom of further rate cuts. He warns that such moves could lead to even greater instability in simple terms. He advises investors to tread carefully in these uncertain times. Are you ready for some important updates? Please stay connected until the end. Let's return to him now. Well,
we have an equity market. When you talk about all-time highs, look, you have some of the worst breadth, B-R-E-D-T-H, breadth, that the market's ever seen. And when you go back and look at market blow-offs or markets that continue to rise with only a handful of stocks leading the way, it always ends poorly. And it was the big seven, and now it's the big four. Mm-hmm. If you look at the S&P 500, the majority of the stocks in the S&P 500 are treading water at best or underwater, and with it, bringing the market along for the ride. And so that's very dangerous as far as I'm concerned. It's very, very dangerous. And, look, we've had several years, let's just take the last year out of the equation, but, 10, 15 years of suppressed interest rates and money creation that has created massive distortions and misallocations of capital and resources, distortions in prices and in asset values. I think that in general, the stock market, to me, is a very dangerous place to be right now. Now, people would say it's an election year, and they're talking about lowering interest rates to support the rally in the market in election year. I can't see how they can lower rates. I really can't. And, it's a situation right now where our debt is ever increasing by $1 trillion every 100 days. Now, if you go back and look at the end of 2023, end of 2022, we had a debt of $31 trillion. $32 trillion. And then it ends a year later, January 1, 2024, it's up $2.6 trillion to over $34 trillion. And that took over 230 years to do it the first time. We did it in a year. And now they're adding $1 trillion every 100 days. We are a government or a country that is addicted to spending. And when you talk about what's happening in the treasury market, you could argue that the weaponizing of the dollar, the inflationary undertones of the dollar, the country that's addicted to spending, all of these things put together are making our treasuries much less attractive. And that's why you're seeing these tails on some of the longer duration treasuries, a tail being that the price that is initially issued, there aren't enough buyers to buy it. So they have to continue to raise the offer higher and higher and higher to attract the buyers. It'll always be buyers, just depends upon what the offering is, how much interest that they're going to pay you. But the bottom line is that lowering interest rates signals to the world that we've given up on ever trying to normalize the balance sheet. We've given up on austerity, and we've chosen inflation as our path. Now, when you are a country that is choosing inflation on one end and at the same time are weaponizing the dollar and treasury market against countries around the world who don't align ideologically, it's a very ominous sign. And so I would simply say to people right now that I don't expect interest rates to go lower. The conventional wisdom is that, that they're going to do it in June or July. And I think that's foolhardy at best. And that's what would spur even further growth in an already over-leveraged stock market. So for me, profit is not a four-letter word. And I think that making a good run in the market the way people have over the last few years, sitting on the sidelines, taking your profit and letting things unwind, letting things play out as we head into what ought to be a very volatile year, into the election, into the 200 meetings that lead up to the big meeting for the BRICS in October. Yeah, I'm not as bullish as the analysts on CNBC are. In fact, right now, I think people should be cautious at very best. Well, look at it this way. Even in the face of and I say this biting my tongue because we know that the CPI is CP lie. We know that the numbers and the massaging of the CPI index is set to accommodate an inflationary agenda by the U.S. government. And they exclude things like food and energy and housing. And if we look at John Williams of Shadow Stats, who only shows the CPI the way it was calculated prior to them taking these adjustments and putting them into the metric back in 1980 and then 1990 when they made it the first adjustment, inflation would be closer to 11% than it is at the 5% or 4% or 3%, whatever the number is. Let's say it's now 5% annualized based by the last CPI reading. So, but for the past 6-8 months or longer, you could argue we've been getting, or even the last year almost, positive real return when you factor in the CPI against the numbers on the 10-year or even the 6-month, not the 10-year, the 6-month Treasury, the short-term Treasuries, where you can get 5.5% in a very short-term duration Treasury, which outpaces inflation if you believe the inflation numbers, right? So in the face of positive real return, which would be the antithesis of gold that doesn't, or the argument people would use against gold, it doesn't pay a coupon. There is no interest on gold. And for the last decade plus, I would say, well, it sure beats the pants off of negative real return or negative return in terms of higher inflation than you have on interest rates in a very low interest rate environment. But in the face of this a positive real return, gold has done very well. It's held up in the face of a return on treasuries that is greater than the inflation rate. So, I don't think they can raise rates. And yeah, they can massage the short end if they want for a little bit. But I think they've kind of reached a point where they're damned if they do and they're damned if they don't. If they continue to ignite inflation through lowering of rates and accommodating the ease in which people are able to borrow money, then you just jack up inflation, which leads to higher interest rates anyway. And you lose confidence. The world will say, they'll never fix it. And we already are losing confidence globally on many levels, as I've touched on. So to retreat from trying to balance or to normalize the balance sheet, to retreat from fighting inflation only signals what much of the world already knows, and they will lose greater and greater confidence. Look, when the bottom line is simply this, is that I think that you can't go any lower in rates or you will begin to precipitously lose demand for the Treasury. And I think that, again, leads to higher rates just to attract people to buy the debt. So they're damned if they do, they're damned if they don't. I truly believe that rates cannot afford to go materially lower than they are right now. And if they did do a token drop, it would be something like a quarter or a half a point, which would mean nothing. And at some point, the market has to, I think, exert itself with greater force than the Fed has the will or the ability to do, because at some point the market is just going to say, look, we don't want your treasury debt issued by a country that is inflating away their currency, which is eroding the value of the treasury, which ultimately leads to higher interest rates. And by the way, the weaponizing of the dollar, where we have our brain dead Treasury Secretary sitting in Brazil, which is a member of BRICS 2 weeks ago, saying we need to confiscate the Russian Forex reserves, the 380 billion in Forex reserves, not just sanction them the way we did Iran, but to confiscate them and use them to rebuild the Ukraine. You've crossed a line, a Rubicon that you can never come back from. The whole Southern Hemisphere will never trust us ever again. And so ultimately, I would say that, pigs get fed and hogs get slaughtered. And if you're using interest rates and interest rate guidance, if you will, as to decide the direction of your investments, I would say take your profit, sit on the sidelines, even if you don't buy gold and silver. you can earn 5% plus in a 6-month treasury with little to no risk. Any duration in the U.S. Treasury market, well, then you start to get into all sorts of risk. And I would simply say that's what the world is seeing. I would simply say that there are better places to be right now where return on your money is great, but return of it is even better. I am not a equity market bull right now, and I'm not a duration bull in treasuries either. But I think the sweet spot for people who are confused right now would be just park it, and you go right to treasurydirect.gov, which is sidestepping all of the commercial bank risk, the systemic risk of the banking system. Go to treasurydirect.gov and buy some 6-month treasuries and wait and figure it out. That is if you don't want to buy precious metals, which, look, the central banks of the world have bought more over the last few years than at any time in human history, really, or any time in banking history. So, it's an interesting, crazy time or an unconventional time where unconventional times call for unconventional thought. And I think it's time to start thinking that way.
As we wrap up this enlightening discussion, we'd like to express our sincere gratitude to our devoted viewers and extend a warm welcome to those who have recently joined us. Your support and engagement are incredibly valuable to us, driving our passion to deliver insightful and thought-provoking content. If you found today's episode informative, we encourage you to share it with your friends, family, and colleagues who could benefit from Andy Schectman's wisdom. And if you haven't already, be sure to hit the subscribe button and turn on notifications so you never miss out on future episodes. Thank you.